Mr. Gould, in recent years, merger reviews have often been conducted using competitive effects analysis that treat insured depository institutions as if they operate in an isolated marketplace, even as fintech lenders, credit unions, farm credit institutions, and other non-bank financial firms now provide overlapping loan and deposit products at scale. As the OCC evaluates future transactions, how do you intend to incorporate kind of the non-bank competitors into the assessment of the market concentration?
Thank you very much for the question. I mean, you're right that deposits are and can be a poor proxy of market power, particularly given the fact that many banks do compete with non-banks across a range of services. And that is why back in 2020, when the then Justice Department was reevaluating their 1995 bank merger guidelines, the OCC submitted a letter to that effect, making that very point that I've just made here today. We would, I think, continue to look to work with the DOJ and their antitrust team in terms of ensuring that when we evaluate mergers and we look to the DOJ for their advice on the competitiveness factors, that they are in fact reflecting the fact that the banking system and the members of it compete with a much broader range of entities than they did, say, back in 1995.
Can you give me like any idea on the analytical framework that you would think is most appropriate to ensure that kind of the competition reviews reflect the full range of providers serving consumers?
Sir, I'd be happy to get back to you on that, but in general, the OCC looks to and receives guidance from the DOJ around that, so their antitrust department gives us advice on that.
Very good, thank you. Vice Chair Bowman, you previously noted that the banks now competitively kind of compete directly with credit unions, which I'm well aware of. I've been in many meetings with bankers and credit unions. And fintech firms and other non-banks offering kind of similar financial products. In the context of the bank merger reviews, would it be helpful for the Federal Reserve to update kind of the competitive analysis to reflect the broader landscape and kind of including all of these different entities? Because it probably would give us a better snapshot on the concentration of findings that probably match the reality of the markets out there right now.
Thank you for that question, Congressman. Yes, it would be incredibly helpful for us to update that merger analysis, especially the competitive factors and the landscape of competition and how we weight each presence of different types of entities in that review.
Very good. Mr. Gould, I'm going to go back to you. Under the prior administration, the OCC's merger posture largely ignored the reality that small and mid-sized banks face escalating compliance burdens and competition from regulated institutions. We often hear that community banks say consolidation is no longer optional, but almost means of survival out there. Is the survival mechanism due to compliance costs and competitive asymmetrics? How do you view that kind of landscape right now?
Thank you for the question. Just to make sure I understand, are you talking about kind of smaller banks or mid-sized regionals or just the whole gamut?
Yeah, I mean, when people come into my office and we visit with the banks, it's kind of a myriad of discussion about what's developing kind of regionally in a state, or how might they kind of better position themselves?
Well, I think it's definitely been the case, as the Vice Chairman noted, that some of the expectations, particularly supervisory expectations, have over time bled down since 2008 to smaller and smaller banks, requiring them to seek economies of scale so they can cover the cost of that additional supervision and compliance. We are and have been, and I think the other federal bank agencies as well, been keen to address this too, which is to reduce some of those regulatory and supervisory burdens, at least where we have discretion to do so as authorized by Congress in statute, to alleviate some of those pressures, such that ultimately, if banks want to merge or consolidate, that's a business decision for them. It's not solely driven by regulatory and supervisory considerations, but the needs of their customers and the evolution of the markets that they purport to serve.
Right. Very good.